Hello guys, mkoaje? I hope kila mtu wako poa. This is E.N.MACHARIA, your accountant, and I want to take this opportunity to welcome you all in today's session and feel comfortable. Karibuni sana sana sana, na kama ndio mara yako ya kwanza kujiunga nasi, tunashukuru sana for choosing to be with us. In this channel, mostly we deal with accounting issues, that is on taxation, audit, bookkeeping, and any other matter relating to accounting. So kama ndio mara yako ya kwanza na uko pale uko na issue to do with that, reach out and we shall sort you out. So today I have prepared something very, very nice for you, and that is to do with taxation. So tulianza this topic ya taxation na tumeangalia withholding taxes na value added taxes, and siku ya leo ningetaka tuangalie income tax. And this income tax nataka kwanza tu divide into two. Ya kwanza yenye tutaangalia siku ya leo ni corporate income tax. So hii ni income tax ya kampuni, and baadaye tutaangalia income tax for the individual people, that is to do with the pay or PSU1. So have a notebook, have a pen, feel comfortable tukiendelea with our session. So nimesema mambo kuhusu na corporate income tax. What is this corporate income tax? It is a tax payable by companies or corporate entities. So kama uko pale umeregister kampuni, lazima uregister pia for company income tax, apply for a PIN number for this company, and you'll be given an obligation for the income tax for the company. So corporate income tax is for both resident and non-resident companies. So for a company to be termed as a resident company in Kenya, this company must be incorporated under Kenyan law, or if the management and control of its affairs are exercised in Kenya for any given year of income. It is also considered resident if the Cabinet Secretary, National Treasury and Planning declares the company to be tax resident for a particular year of income in a notice published in the Kenyan Gazette. So for a company to be termed as a resident company in Kenya, one, it must be incorporated under Kenyan law. Two, its affairs should be exercised in Kenya. And three, if the Cabinet Secretary for National Treasury and Planning declares the company to be tax resident for a particular year of income. So inaweza kuwa ni hii mwaka, but for the future ibadilike ikuwe non-resident. Nayo non-resident companies ni zile kampuni ziko hapa lakini ziko registered in other countries. So unajua kuna zile companies zenye ziko na branches hapa but their origins are from other parts of the world. So hizo ndizo tunaita non-resident companies. So Under this income tax, there is a tax that we call installment tax. So I know a lot of people do pay this tax. And this tax is very, very beneficial to the taxpayer. Why am I saying so? Because this tax, it's like you paying an advance payment. So, like at the end of the year, you've found that you are supposed to pay $1 million Kenyan shilling tax, but within that period umekuwa ukilipa in advance, at least umelipa like 500,000. So your 1 million will be deducted the 500,000 that you've paid in advance. So it really help or ease the tax payable for the taxpayer. So if you can manage to pay this installment tax at the specific time given, at the end of your financial year, you will not have any constraints paying your income tax. So installment tax, what is this installment tax? Companies are required to pay in advance in 4 equal installments during the accounting period, in which is known as installment tax. So in a financial year or in accounting year, each and every company is required to pay the installment tax into 4 equal installments. So the installment tax is tax paid in advance and is due and payable by 20th of the 4th, 6th, 9th, and 12th month of a company's accounting period. So for each and every 20th of the 4th month, the 6th month, the 9th month, and the 12th month, you have to pay something for the installment tax. And this one, it's not a fixed amount. You can opt to pay as much as you can. So upon determination of the total tax payable after the end of the accounting period, the installment tax is paid during the year and shall be deducted from established total tax payable, and the balance of the tax, if any, is due and payable by the last day of the 4th month after the accounting year. So what do I mean? If in the accounting period runs from January to December, so mwaka yako ya kibiashara inaanza January to December, then the balance of the tax is due and payable by the last day of April the following year. Kama mwaka yako inamalizikia December na inaanza January, so your last day of or your balance of tax is due and payable by the last day of April the following year. So mpaka hapo, I know you will not find yourself in a fix, hujui unafaa kulipa income tax ama installment tax kivipi. So how do you determine this taxable income, or how do you determine taxable income for tax return? So remember, ukisha determine the income tax, you must file and pay. You must file the return and then make the payment. So at the end of the accounting period, companies are required by law to have their books of accounts audited before lifting their annual return within 6 months after the period end of the accounting period. So I urge each and everyone, kama uko pale, you have a company, make sure your books of accounts are in order, are well maintained, you have all the records. Make sure you have an external auditor who can audit your books. After that, you'll be in a position to file your returns and pay the tax that may be payable. So the company tax return is available on iTax. So after all this, utaenda pale in iTax, you file your return. So to determine the tax that you are supposed to pay, or the taxable income which is subjected to this income tax, so the taxable income as declared in the corporation tax return is arrived at by declaring the gross income earned during the year and deducting expenses that have been wholly and exclusively incurred in the production of income. And underline the word production of the income. So a lot of people do deduct expenses that are not related in the income that they are calculating. So when the taxman visits you, you have a very hard time to explain this. So always deduct the expenses that were used in the production of the income. So usianze kudeduct expenses because you have the receipts, they are not even related to the income generated. You'll have a very hard time to reconcile your accounts when the taxman visits you. So the rates for this income tax for non-resident is 37.5%, and for resident 30%. And remember, you must file your tax returns on time and make payments on time, failure to which this will attract a penalty of 5% of the tax due. So let's assume you are supposed to pay 100,000. 5% of 100,000 is 5,000, or 20,000, whichever is higher. So wataangalia is 5% of the tax due higher than 20,000. So whichever is higher, that's what they will penalize you. So kama ulikuwa ulipie 5,000, hawatachukua hiyo 5,000 as penalty, watachukua the higher, which is 20,000. So this is like they want to punish you with this. So make sure your books of accounts are audited on time, returns filed on time, keep your records well, accurate, have an external auditor, a person who can verify and reconcile all your accounts, and you'll be in a position to pay the correct income tax. Thus, even if the taxman visits your premises, you will not panic. You will not have a very hard time to explain yourself. And as always, keep your records well for references. For the income tax, keep your records as long as 10 years. So zikipitisha 10 years, unaweza ziweka store. But before that, a taxman anaweza kuvisit anytime. So make arrangements and know how to handle your income tax. And with that, when we shall meet again, we shall now look at the income tax for the individual. The income tax for the individual, that is on PSU1, as many people call it, payee. So until then, go on subscribing, go on watching, share the content, and we shall have as many people as possible onboarded on this channel. Thank you very much. Have a lovely time. Thank you.